Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels, ticker UUUU, and this is a stock that's really become less about just commodities.
Yeah, more like a geopolitics play almost.
Exactly. So the big question we're tackling is it a good time to buy now?
We definitely want to hear from you on this one. Subscribe, like, and comment to support the show. And hey, if there's a specific company you want us to look into, please leave it in the comments below.
Okay, so let's get into the analysis. We've got a good stack of sources here, and they seem to paint a pretty clear picture. High growth potential.
But also some big upfront costs, right?
That's the flip side, yes. Significant investment happening.
So let's maybe unpack the story first. Yeah. Because energy fuels, it's fundamentally quite unique, certainly in the North American market.
It really is.
It's one of the very few pure plays on two absolutely critical materials: uranium and rare earth elements.
Yeah.
You really can't overstate how strategic that dual identity is right now.
No, you can't. And that's the core reason the market's paying so much attention. Energy fuels holds this really critical strategic role in the whole U.S. drive toward critical mineral supply independence.
So if you're looking for a company with a strong structural, moat, this seems like a prime candidate.
It really is.
And that moat isn't just about, digging stuff out of the ground, volume. It's about the industrial process itself.
Yeah.
Could you walk us through why their method for rare earth processing is such a potential game changer?
Certainly. So what really sets them apart is their vertical integration, specifically how they use monazite sands.
Monazites, okay.
Yeah. Think of monazite as the raw ore, basically, that holds all those valuable rare earth elements, but separating them, that's incredibly complex.
Right. Energy intensive.
Hugely. And historically, that whole process has just been dominated by China.
Okay, so if the U.S. wants its own domestic supply chain, from the actual mine, the dirt in the ground, all the way to the specialized chemical that goes into, say, a fighter jet or an EV battery.
They need this capability.
They need this specific capability.
Exactly. Energy fuels isn't just digging up ore and shipping it overseas for someone else to refine. They're actually operating the mills, the separation facilities, right here domestically.
Which ties their success directly to U.S. policy then?
Directly. Policy aimed at securing non-Chinese supply chains, whether that's for defense systems, advanced batteries, clean energy infrastructure.
The government needs partners for this.
They're actively looking for partners who can actually do this, and energy fuels is, pretty high up on that very short list.
And that geopolitical story, it seems like it's translating directly into investor conviction, especially when we look at the financials.
It does.
Their trailing 12 months revenue, the TTM, it's pretty robust at $65.08 million.
Yeah.
Shows strong demand in their end markets.
Yeah, solid top line.
And analysts, they seem to be betting really heavily on this story continuing.
Oh, they absolutely are. The consensus expects extremely strong year-over-year revenue growth. They see tailwinds in both the rare earth and the uranium markets happening at the same time.
Which is pretty rare.
It is, but the headline that really caught everyone's attention, I think, was that huge analyst upgrade from B. Riley.
Right, that's the one we flagged earlier.
Yeah.
Where they raised their price target pretty dramatically.
Dramatically is the word. They took their target from $11 all the way up to $22.
Wow.
Yeah, that's not just a small tweak, right? That's an analyst basically saying the market has fundamentally undervalued the company's long-term strategic position and, crucially, its ability to actually execute this whole vertical integration plan.
Okay, but we have to talk about the cost, the current financial cost of building that future.
We do. This is where it gets a bit more nuanced.
Because looking at the TTM net income, it sits at a negative $93.10 million. That's a huge loss. How do we square that circle with all this analyst confidence?
Well, we reconcile it by understanding the stage of the business cycle they're in right now. That $93 million loss, yeah, it looks painful on the surface.
It does.
But it's entirely expected. It's actually necessary. The company is aggressively investing. They're spending money now to ramp up capacity to shift their product mix away from just, lower margin raw material.
Towards the high value stuff, the separated rare earth products.
Exactly. They are essentially building the infrastructure for that potential future $22 valuation right now, today.
So the market isn't seeing this loss as like operational failure. It's seeing it as CapEx, capital expenditure with a long-term payoff.
Precisely, that's the narrative. And thankfully, their balance sheet seems to give them the foundation to actually sustain this build-out.
Okay.
They currently command a market cap of what, $4.40 billion, and their legacy debt levels are pretty moderate. So the key question for sustaining this growth was always going to be financing the current build.
And they seem to have solved that potential cash crunch with a major debt offering. That's a really crucial detail for anyone looking at buying in, I think.
It is, yes. They secured a $700 million convertible note offering fairly recently. Now, for our listeners, this detail is vital. A convertible note, it's debt now.
Right.
But it gives the bondholders the option to convert it into stock later, usually at a premium to the current price. So this move, it basically bolsters their liquidity, shores up their cash position through at least 2026.
So it funds a big expansion plan.
Without placing excessive leverage pressure on them today.
But that word convertible,
Yeah.
that carries risk down the road, doesn't it? If the stock price really takes off and those notes convert into shares, what does that mean for the people holding stock now?
It means future dilution risk. Simple as that. If the notes convert, you own a slightly smaller slice of the pie.
Okay.
However, the argument is if they execute successfully, that whole pie will be so much larger and more valuable that the dilution effect will be a relatively small trade-off for what could be a massive gain in the company's total value.
So it was a strategic choice. Fund growth without, say, crippling interest payments from normal debt or just diluting shareholders immediately with a straight equity offering.
Exactly. It kicks the dilution can down the road, conditional on success.
Okay, let's maybe transition now from that fundamental story to how the technical traders are reacting. Because this financial narrative of future growth seems vividly reflected in the price action. The current price is sitting around $20.03 as of late October.
Yep, just over $20. And we are in a definitive, pretty healthy uptrend. If you just look at the simple moving averages, the SMAs, you see a clear bullish picture.
How so?
Well, the price is comfortably above the 50-day SMA, which is around $15.70. And crucially, the longer-term 200-day SMA is way down at $8.12.
Wow, that's a huge separation between the short-term and long-term average.
It is, and that huge gap really confirms that this rally has serious momentum. It suggests institutional backing is building.
Yeah, that big gap tells you the market's conviction has really accelerated sharply in 2025. What about the immediate health of the stock, though? Is it running too hot? Is it overbought?
Good question. That's where we look at a momentum indicator like the RSI, the Relative Strength Index. It measures the speed and change of price movements.
Okay.
Right now, the 14-day RSI is sitting at 53.47. Now, for listeners, anything above 70 usually means a stock is getting overbought, maybe due for a pullback. Below 30 is oversold.
So 53 is?
It's pretty much neutral to bullish. It indicates healthy upward potential still, without being overheated. It suggests the stock has room to run higher before it gets technically stretched.
Okay, so technically speaking then, if an investor is maybe looking for an entry point or perhaps planning an exit down the line, what are the key price levels they need to be watching in the coming weeks?
Right. We need to define the sort of technical battlefield. The critical support level, the floor we want to see hold, is down near $15 to $16.
What that level specifically?
That area was basically the ceiling of the last major consolidation phase before this recent breakout. So holding above it confirms the strength of this new bullish structure.
Got it. And on the upside, the resistance.
The technical resistance seems centered around $25 to $27. That's up near the stock's 52-week peak.
So breaking through that $25, $27 ceiling would be a big signal.
A very big signal. It would confirm the market is likely moving towards, or maybe even past, that ambitious B. Riley $22 price target we talked about.
And the short-term projection, the models, they seem to confirm that we should probably stay in that higher range through the end of the year.
Yeah, the models project a bullish trading channel holding roughly between, say, $17.59 on the low end and $25.12 on the high end through the rest of 2025. The technicals really suggest the market is kind of poised, waiting to capitalize on any positive news.
Right, any positive news coming out of the company. Or maybe Washington, D.C. Speaking of news, let's focus on those immediate triggers. The sources really highlight that the stock has been incredibly sensitive to positive news lately, gaining, 7% to 12% just in late October.
Yeah, following that burst of bullish analyst commentary.
And that analyst consensus remains incredibly strong. Like 75% to 100% of firms rating the stock buy or strong buy. That's pretty overwhelming.
It is. But the Closest, most important near-term trigger is definitely the Q3 2025 earnings release that's scheduled for November 6th.
Okay, so just around the corner.
Right. Everyone is watching this date. Expectations are extremely high, not just for, robust top-line revenue growth.
But for the details, right. An update on the actual commercial ramp-up of that high-margin rare earth separation process.
Precisely. A positive surprise there, or even just confirmation they're on track, could really ignite the stock further.
And beyond the corporate calendar, we have those more speculative drivers tied directly back to geopolitics. We keep hearing market chatter, speculation around potential significant U.S. government contract awards.
Maybe from the Department of Energy, yeah.
Or just major policy action aimed squarely at securing critical minerals, which would obviously benefit Energy Fuels directly.
Those policy actions are kind of the macro catalyst, the big picture driver. But there are also some important institutional catalysts to watch. Fund flows matter a lot here.
Okay, like what?
Investors should probably mark 2 dates on their calendar. First, the uranium ETF rebalancing announcement on December 15th. Depending on how they adjust weightings, that could force large fund flows into, or maybe even out of, the stock.
Interesting. And the second date?
Then there are the institutional 13F filings due around January 10th.
Okay. Why are those 13F filings so significant for this story?
Well, that's when the big players, the large hedge funds, the institutional investors like pension funds, mutual funds, have to disclose their holdings from the previous quarter.
So we see who's been buying or selling.
Exactly. If we see a massive influx of reputable institutional money showing up in those filings, the Vanguards, the Fidelities, major well-respected hedge funds, it provides crucial confirmation that the so-called smart money is actively accumulating the stock. It really validates the long-term thesis.
Okay, good point. Let's pivot now, though, just briefly, to the remaining risks. Because no high-growth story like this comes without potential downsides. The sources did note some insider selling, which often raises a red flag for investors.
It does, and we absolutely have to acknowledge it. Executives have sold over, I think it was $5.5 million in stock recently.
Which sounds like a lot.
It is a decent chunk. However, the context here is important. That selling, according to the sources, has been largely and repeatedly offset by the increasing hedge fund and institutional inflows we just talked about.
Okay. So money coming in from big funds is outweighing executives cashing some shares out.
That seems to be the overall picture, yes. The consensus interpretation seems to be that while some executives are naturally taking some profits off the table after a big run-up, the external confidence, the institutional confidence in the long-term growth story, remains overwhelming.
So maybe the biggest risk isn't really insider activity or even the market itself, but something more fundamental, something internal to the company's own capabilities.
Absolutely. I think the greatest company-specific risk here is simply execution.
Makes sense.
Look, Energy Fuels has successfully secured the capital they needed via that convertible note. They clearly have the right strategy aligned with government priorities. The challenge now is just flawless operational execution and maintaining cost discipline as they scale up those incredibly complex rare earth separation capabilities.
So any significant delay or maybe a big cost overrun in building out those facilities?
That would immediately undermine the entire vertical integration narrative. That's the core risk investors are watching. Can they deliver on the plan?
Okay, so bringing all these different threads together, then the geopolitics, the massive investment phase, those bullish analysts, the strong technicals, what's the final synthesis? The final investment thesis. Is now the time to buy UUM?
Well, based on our analysis of all the sources, the overall thesis comes out as highly bullish. I'd probably score it maybe an 8.5 out of 10 in terms of conviction from the materials we reviewed.
An 8.5, okay. That's strong.
It is, because this stock is pretty unique, right? It's a structural growth play that's fundamentally tied to global geopolitics specifically, that U.S. push for supply chain independence in 2 absolutely critical sectors.
Uranium and rare earths.
Right. And it's supported by accelerating revenue, by robust technical momentum that still shows room to run, and, crucially, by multiple powerful near-term catalysts, especially that Q3 earnings report coming up.
So it really sounds like the sources suggest this stock could be attractive for 2 quite distinct types of investors. Well, both maybe short-term traders who are looking to play those immediate catalysts like the November earnings or maybe some regulatory news out of Washington.
Okay, yeah.
And also for long-term, more structural investors who are really seeking exposure to that big multi-year story of securing U.S. dominance in these critical materials.
I think that's a very fair assessment. Considering the ongoing geopolitical urgency, that push for supply independence, the core question really isn't just whether commodity prices will rise, although they probably will help.
Right.
The real question is whether Energy Fuels can successfully execute its highly complex vertical integration strategy. Can they turn those monazite sands into purified domestic rare earth chemicals reliably? And can they do it cost-effectively?
And that execution.
That execution, if they pull it off, will be the main driver validating that ambitious $22 all-list price target.
We'll certainly be watching those November earnings very closely. Thanks for tuning into this analysis.